Thank you very much, Amy. Well, good morning, good afternoon, wherever you're joining us. Thank you for taking part in the third installment of the webinar series related to the financial statement cycle with nonprofit organizations. If you attended any of our previous webinars in March and April, you know we talked briefly about the budgeting process and an internal look at the financial statements, and excited to talk to you today about the external look at the financial statements. Just some background information on myself. My name is Reed Matson. I'm a senior manager in the Business Outsourcing and Strategy Department, located in our Fargo, North Dakota office. I've been with the firm for about 12 and a half years and have spent a majority of that time actually working in our auditing department with a large focus on nonprofit organizations. Recently, I did transition to our Business Outsourcing and Strategy Department, and have been fortunate enough to see the other side of the financial statements, working closely with our clients as an advisor and a consultant in looking at it from a different purview. I also have the ability to serve on a nonprofit board, and so I have had the chance to work with our board of directors and management, again, to see a different vantage point, a different viewpoint on the financial statements in that process. So excited to share some of those experiences with you today and talk through some of those items. And with that, I'll turn it over to Joseph for a brief introduction.
Hi, I'm Joseph. I'm with the assurance department of Eide Bailey. I spend most of my time auditing the financial statements. A lot of those financial statements are for nonprofits and government entities, both the financial side and the compliance side. And I'm looking forward to talking about some of the special project accounting services that might interest you and might provide a benefit to your organization.
Sounds great. Thank you, Amy. And as you can see on this next slide, this is an accountant's attempt at dry humor. So putting a few slides in there to maybe poke fun at auditors and accounting, because every once in a while we do like to laugh at ourselves. And if you ask my father-in-law, he's certainly got a different look of accountants, and the many mugs in my kitchen will prove that with some of the accounting puns that we have. Well, let's talk briefly here about some of the things that we're going to discuss today. And so when we talk about external financial statements, a couple of areas that we want to make sure and focus on that you can see outlined here, whether it relates to some of the assurance reports that we'll go through the different types. Maybe it's the annual reports that organizations are putting out, or some of the analytics or non-financial data that Joseph will touch on here later this afternoon. So one of the things I always like to do when I'm starting on a project or a presentation, for any of you that are familiar with Simon Sinek's TED Talks, he has one that talks about how great leaders inspire action, and it's largely based upon his book, Start with the Why. And oftentimes I'll go back to that TED Talk and watch it as a refresher to when I'm looking at a topic to think about the why. And so when I was preparing this presentation, talking about external financial statements, and as we'll talk about some of the assurance reports, I got to asking that question. So with the audience, why should you care as an organization about these external financials? Whether you're management, board of directors, or an employee, why should you care? And as you can see on there, that first bullet point really puts it pretty well out there. Oftentimes because there's someone relying upon these assurance reports or these financial statements. And that could be a banker looking at a loan to determine whether or not they want to give you have the credit worthiness for that. It could be a donor making a decision on whether or not they're going to give you a major gift. Or it could be a granting agency looking at your financial statements to determine whether or not they would like to issue you a grant based on your performance and your operations. And so often, one of the difficult parts when we talk through these assurance financial statements, these external financials, is they do fall under, typically a standard, a certain set of financial statements set forth by a governing body, the Financial Accounting Standards Board, under the accounting standards. And, the accounting standards for nonprofits are not simple by any means. There's complexities and nuances to nonprofits. And so often I think a lot of people maybe don't understand the why. And I think a larger reason why too is because, A, you have someone relying on those financial statements, but B, you also want to make sure that those financial statements are consistent across nonprofits, so that if all the nonprofits are following the proper standards, when you're doing a comparison of nonprofit A to organization B to organization C, you're not comparing apples to oranges. You've got commonality on how these financial statements are reported. And so again, something important to keep in mind when we talk about this grand scheme of the why behind financial reporting, external financial statements, and in particular those assurance reports. And typically these are usually prepared by independent third parties. And I'll touch on a summary here in a little bit on some of the differences between these different types of assurance reports and some important things that I think are very beneficial for you all to know. So let's touch on the assurance reports in particular. So often, again, the why gets missed in this entire process. So let's touch a little bit about what might require you as an organization to have assurance financial statements presented. Oftentimes there's a state requirement. So again, as I stated, I'm in Fargo, North Dakota, which is right along the border of Minnesota. North Dakota does not have any audit requirements for nonprofit organizations, but if you go across the river into Minnesota, Minnesota has a requirement where any nonprofit with more than 750,000 of revenue annually is required to have a financial statement audit. So depending upon which state your nonprofit is located in, you could have a requirement for assurance financial statements. In this case, with Minnesota, there's an audit requirement. A lot of times you'll see granting agencies require that an organization have a certain level of financial statements presented. Again, that might be a compilation, a review, or an audit. Depending upon the size of the grant you're applying for and the certain terms of the grant agreement, you'll likely see that as a requirement inside of some of those. Loan agreements as well. If an organization is planning on taking out a significant debt load or has a loan with maybe a little bit higher risk, it's certainly possible that the financial institution might require that the financial statements be prepared by an independent CPA and a certain level of assurance put on those financial statements at the end of the day. You might also have insurance requirements or bylaws. And what's interesting with the bylaws is I've worked with a number of organizations over the year that they'll say, well, we get an audit because our bylaws require it, or they might even say our bylaws require an audit, but we haven't had one performed. And so sometimes that's a good reminder for organizations to go back and look at those bylaws and review them on an annual basis to ensure, is this really what's in the best interest of the organization, and making sure that you're doing what's right by the organization and what fits your organizational model. You might also have a national affiliate that could potentially require this. I know I've worked with a number of local chapter organizations that have different level of assurance financial statement requirements that get reported up to a national level. And so that certainly could be a requirement as well. Or I guess one that's not even on here as well is you might have a board of directors or management that just feels that it's the best process for the organization to go through to have a financial statement audit, a financial statement review or compilation, something else to give that third party independent review and perspective on the financials and issue these financial reporting. So just a summary here of the types of the assurance reports. I would say the first 3 bullet points on here are probably the most commonly known types of assurance reports that most nonprofit organizations deal with when we talk about an audit, a review, and a compilation. There are a couple of other different options that I would say a lot of organizations aren't aware of. The fourth bullet point on here, you can see the agreed upon procedures, and other ones being forecasts or projections. And really agreed upon procedures, I won't get into a lot of detail on it here, but there's a lot of flexibility with what's included there in terms of the terms of the procedures that are performed and the conclusion that's reached at the end of the day. Whenever I'm talking about assurance reports, external financial statements, I really love this slide because I think it gives you a great overview and a great summary of what the differences are between, again, a compilation, a review, or an audit. I've been fortunate enough to work really across all ranges of these types of assurance financial statements, working with a number of compilations and reviews and audits. And I can tell you the number of times that I've worked with a client on reviews and compilations, and the report is referenced as an audit is probably more than I can count. So often organizations have this conception that I'm dealing with a CPA firm, an accounting firm, so the report they're giving me is an audit. And I think it's very important for you all as attendees to have an understanding of this, because if you're getting a compilation, if you're getting a review, and you're communicating this to anyone that it's an audit, there's certainly a vast difference in there. And again, we go back to the why, the reliance upon these financial statements. If you think, if you're communicating that it's an audit, but it's actually a review or compilation, that level of assurance is significantly different, and the reliance that's placed upon them can certainly change. And so one of the things I always like to point out again is this level of assurance that's given on the three different types of assurance reports on here. So you can see an audit, if we start out on the far right, gives reasonable assurance, and a review is limited assurance, and a compilation is no assurance. And what gets really tricky when you're looking at financial statements, these external financials, is on the very bottom, you can see there the footnotes to the financial statements. And typically when you're reviewing through these, it's not just the financial statements, so the statement of financial position, statement of activity, statement of cash flows, but also footnotes that's included in there. And so you could run into a situation where you have an audit, a review, and a compilation. And when we talk about the financial statements and the footnotes, they would look the exact same, regardless of the level of assurance. And what's different is there's typically a 1 to 2 page report at the very beginning that will either outline the independent auditor's report, or the independent accountant's review report, or the independent accountant's compilation report. That will tell you the level of assurance provided and some of the work performed, but the rest of the financial statements might look the exact same. So it is very easy for a reader to pick up those financial statements and maybe gloss over that first page or two and just cut right to the financial statements and not look over the level of assurance provided. So I think that certainly complicates the matter when you're looking at this and making a determination on, again, what that level of assurance is that's done on your financial statements and understanding the work that's performed. And so that's where you see on the second line down, when we talk about procedures required, again, if we start with an audit, there's inquiries of external personnel and internal personnel, analytical procedures, and audit procedures, whether that's testing the accounting records, observation, confirmation, or other substantive procedures. Quite a bit more work compared to the other two. When we step down to a review, we've got inquiries of internal personnel and analytical procedures. And then on a compilation, technically no procedures required unless the information is questionable. So really reading through those financial statements for any errors or omissions or corrections that might need to get made. Another area that's important to note too is when we talk about independence on the third line. Independence is required for an audit or review, but not for a compilation. So it's very likely that you might have, if you're working with an external CPA for some of your bookkeeping services, your outsourced accounting services, and that CPA firm is responsible for preparing journal entries, has access to your general ledger and posting entries, they would not be considered independent. And so they could not issue a review or an assurance report, but could issue a compilation report. It would just be stated on that report that the firm is not independent with respect to the client that they're presenting on. So again, some important differentiations that management, board of directors, employees should know when you're evaluating these external financial statements, when you're looking at which ones are performed, and you look at who's relying upon them and where they go to at the end of the day. This is always a part of the presentation when we talk about financial statements I really love to discuss, because in my mind, when you're looking at these external financial statements and some of these certain ones that we're going to touch on here, it's really a chance to tell the story, to interpret the story of your organization through the financials that are presented here. And I always like to have these discussions so that organizations understand, when you have, again, a third party or somebody that's relying on these financial statements, what are some of the things that they're looking at? What are some of the key financial areas that you should be paying attention to in these financial statements and these specific statements that we'll touch on here? And so that's what we're going to talk on in the next couple of slides. And again, important that you understand the distinction and what's included in here in some of the areas of importance. So if we start with the statement of financial position, a lot of organizations might refer to this as the balance sheet. Again, this is just the financial position of the organization at a specified point in time. And for most organizations, that will be at the end of their fiscal year, whether that's December 31st, June 30th, whatever you might have. And really one of the areas that most organizations and most individuals, when they're looking at this, and certainly myself when I'm reviewing financial statements that you look at, is what type of liquid assets does the organization have? If there's anything these last 14 months have taught us, and in particular nonprofits, it's the importance of cash and having cash on hand and liquid assets available with some trying circumstances that a lot of nonprofits have found themselves in recently. And so when you're looking at this, it gives you the ability to take a look at these financials and decipher what type of liquid assets are available. So in this case, we've got cash and cash equivalents and investments. Whether or not there's some liquidity to those is outlined in the footnotes to the financial statements. But then you've also got maybe some accounts receivable and some promises to give that are due in the coming year that would be considered liquid to the organization, because the cash would be collected in the next 12 months. So having an understanding of what that liquidity looks like and what those assets are that are expected to be held for liquid purposes going forward in the next 12 months is certainly an area I look at. And I'll touch on one of the footnotes here later on too, where I really find it beneficial when doing comparisons to other areas of the financials. Another area of importance is the debt or financing obligations that an organization might have. So in this example financial statement that you see here, this organization really just has a line of credit from a debt servicing perspective, likely a revolving line of credit that would be due. But you might, as an organization, you might have long-term debt that's included on the financial statements. You might have a long-term capital lease that's included on there, possibly for some equipment purchases, or maybe a contract for deed payable. Other obligations that you would have as an organization, it's important to look at those and weigh those in terms of what the overall balance is, how much of that is current. And again, I'll touch on that in a little bit as well, but certainly some things that we look at in terms of the overall financial health of an organization from a statement of financial position perspective. The last one as well is the net asset composition. And so again, when we talk about net assets, the accumulated earnings, the equity of a nonprofit organization, it's split into two different areas. The first being with donor restrictions and the second being without donor restrictions. This gives you that high level overview of what's that total balance, what's that mix between the accumulated net assets of the organization that still has to be held for donor restricted purposes and what amount is left for unrestricted or general operations. When we get to the statement of activities, what I most commonly see, and this isn't just particular to nonprofit organizations, this is really prevalent to all businesses and organizations, is what do most people do when they get this statement in front of them? Most people take a look and they'll scroll down and they'll say, what's that net income? What's my change in net assets? And I'll admit I'm just as guilty as others when I look at this. That's the first number I point my finger to. And really, what the statement of activities does is it just tells a portion of the story for the financial results of the organization. And I'll touch on the other statement that I really like to tie this into when I'm reviewing the financial performance of an organization for a given year, because this only just tells a portion of that story. But a couple of the areas I really like to look at, and when you're analyzing a statement of activities, is how is the organization supported? So as you can see down here, what's the revenue mix? So as an organization, the ones that you can see here as this example, they're supported by some of their adoption fees and their education programs. So the program services generate a large amount of revenue. They also have contributions and grants and some special events, as well as investment income. And really the reason why I like to look at this revenue mix is, again, because of this second bullet that's right underneath there, the volatility of any of the concentrations of some of these revenue mixes. And where you see this come into play is when you run into circumstances that are outside of a traditional year of operations. I look back at the last 14 months being exactly that case, where if you have an organization that's heavily reliant upon special events and events generating revenue for the organization, you were likely impacted more than maybe another type of organization that wasn't as heavily reliant upon these past 14 months. Or if you have an organization that's largely supported by program services and there's still a need for that program, that's going to be in a different situation than an organization that's heavily reliant upon contributions. If you're heavily reliant upon contributions, you may see more changes year over year in that dollar amount as you get maybe a large contribution one year that potentially only happens every 5 years or so. You might see a little bit more volatility in that revenue mix and where those funds are coming from the organization. Another area I really like about this statement, and the Financial Accounting Standards Board did a great job of clarifying this and cleaning it up a couple of years ago with the standard update that they put out, is it makes it very clear in terms of the language that's used on here for the column approach. When we talk about the financial statements and the financial performance for the last year on amounts that are considered without donor restrictions and with donor restrictions for an organization. And really the reason why I think this is so important to look at is if you have an organization that has a lot of activities or a lot of situations that are arising where they're getting donor restricted funds, that balance can really change how your financials are impacted and how they're reviewed and analyzed. And maybe an example I will give is if you have an organization that is in the process of doing, let's say, a capital campaign. So maybe you've got a large asset purchase that you are looking to raise funds for in the future. And if your organization that is fortunate enough to have, let's say, maybe 3 major contributors that are giving you $50,000 a year in contributions towards your general operations, and as you're doing this capital campaign, if you make this push to these major donors and say, would you be willing to help support this project? Let's say they're fortunate enough to say, we'll each give $100,000 towards this capital campaign. So now you've got $100,000 of revenues and support for amounts with donor restrictions. But since these donors have given funds to a specific project above and beyond what they normally have, maybe their regular contributions that are unrestricted, instead of being 50,000, maybe those drop down to 10,000. So the impact on this is that you've subsequently shifted funds from without donor restrictions to with donor restrictions, and that balance has gone down. And again, just an area that's important to know so that when you're analyzing this, if you've got funds that are shifting from one purpose to another, the impact it has on the financials. Because in this situation, if you can look at this example financials on here, the change in net assets, while it's positive, is also positive for both areas. One area that's commonly looked at is, let's say if this change in net assets, the overall was only 200,000, we'd have a situation where the amount with donor restrictions is going up, but the net assets without donor restrictions is going down. And if you were to see a trend where this happens for a number of years, what that could tell you is that maybe you're running into a situation where you're getting donations for restricted purposes, but you're just not able to fulfill those obligations as fast as the revenues are coming in. And so an area to look at, to keep in mind when you're analyzing this statement and looking at donations as they come in from a restriction standpoint, and really understanding what it means for your organization, again, in terms of where you're at from a restriction standpoint. If you're the type of person that likes to look at financials from, let's say, a 10,000 foot perspective, this does give you a nice summary of the high level expenses in terms of where they're going. So in this case, we've got our expenses for program services, animal care and outreach and education on here, and then some of the supporting services for management in general and fundraising and development. And that kind of ties into the next statement that I'm going to touch on here as well, which is something that was just recently required for external financial statements. If you go back a couple of years ago, this was not a requirement for organizations to put into their external financial statements. And now it is. If you have an audit or review, it's either required to be included on the face of the financial statements or on the footnotes. And for someone like myself who works with financials all day, every day, I love this statement because in my mind, it gives me great clarity and a great amount of information on not just the breakdown of the natural classification of your expenses, but also the functional nature. What we mean by that is your program services, your general administrating, and your fundraising and development. And really what I like too is it gives you an overview and a mix of where your expenses are spent by each department. And so often I see too, when organizations are doing an analysis of this and looking at this, they'll look at the percentages. So what percentage of our expenses are we spending on management in general, as opposed to the program services as opposed to the management in general and fundraising and development. And the tricky part with this is so often those percentages, those are going to vary based on every single type of nonprofit organization. And maybe some examples of why they might vary is if you have an organization that's majority of their support comes from the program services that they generate, a lot of those expenses then are likely also going to relate to the programs that they serve. And so you might have a higher percentage of expenses on the program services side and not so much on the management in general and the fundraising and development. Conversely, if you have an organization that relies heavily on fundraising, you're likely going to fundraising and contributions, you're likely going to have probably some dedicated staff that are responsible for going out and soliciting funds from contributions, maybe from writing grant agreements. Your expenses then on that fundraising side are going to be higher than different types of organizations. And so again, when we talk about what those percentages are and why it's not always comparable between every organization, that's why. And that's why I think having a good understanding of what's included on this statement and really all of these and tying them back together at the end is certainly important to look at. The last bullet point that I have on there too, I think is really relevant on there because really when we talk about this statement, the more accurate it is, the more useful it is. And what I mean by that is if your organization looks at your overall expenses at the end of the year, let's take payroll and salaries, for example, and says, well, we're about 70% to our program, 20% to our general administrative, and 10% to our fundraising. And that's where we end up at. It gets tied into these external financial statements, reported maybe 3-4 months after the end of your fiscal year. You take a look at the overall percentages, the overall numbers, and at that point in time, are you really in a position to make a lot of changes when you're 3 to 4 months after the end of the year, as opposed to maybe an organization that tracks the time internally on a tracking system where individuals raising, and those numbers are tracked in real time and reported on your financial statements, then you've got better insight, better purview into what the financial performance of your programs look like, what those overhead expenses are on management in general and program. You've got that real-time data, you're able to make those decisions faster and easier. And so that's what I mean by the more accurate this is, the better you track, report these numbers really throughout the year and then also at the end of the year, the more useful this is going to be to you because it's going to give you more accurate and better information to make those decisions on whether you're a board or management or, again, one of these outside parties that are relying on your financial statements at the end of the day. And now we get to my favorite statement on here, the statement of cash flows. And again, when I'm talking with nonprofit organizations with management and board, I always emphasize the statement of cash flows is something you have to look at when you're looking at the financial performance. You look at this in combination with that statement of activities, because as all of us have realized in the last 14 months, cash is so vital to nonprofit organizations, and not just the ability to have cash, but I would say the understanding of what you're doing with your cash, where your cash is coming and going. And that's really the premises behind this statement and why it's on here, so that you can have an understanding of where's your cash coming and going as an organization. And really it does this by separating the statement out into 3 different areas: operating activities, investing activities, and financing activities. And to me, one of the areas I always look at when I'm looking at this statement of cash flows is I'm looking at what did the organization generate in cash from operations in the last year. So in this case, our example organization that we have generated $484,000 of positive cash from operating activities. And why is that important to look at? And it's really because of these next couple bullet points. Because if your organization generates positive cash, I want to look at what are you doing with that cash? Is it something that's getting reinvested into investments? Is it getting reinvested into your property and equipment for capital purchases? Are you paying down debt financing? Where are those areas going? Where is the excess cash going for the organization? And conversely, that positive cash, I think, a lot of organizations might have a tendency to say, well, I've generated positive cash from operating activities. That means we had a good year. We did what we were supposed to do. If we take a look at an example of why that's not always the full story, let's say an organization generated $50,000 in positive cash from their operating activities. If you've got debt financing and debt commitments out there, let's say if you had a principal amount of debt due of $100,000 and you only generated $50,000 of cash from operating activities, you didn't generate enough to cover your debt obligations. And so knowing what that number is as an organization, I think is important too, because again, if you've got capital purchases you want to pursue, or you have debt financing, it's important to know how much cash you need to generate throughout the year to cover those other obligations that you have. And so the last bullet point too, a lot of organizations might run into a situation where that number is negative. So they've operated at a standpoint where they haven't been able to generate enough cash from operations. So if that's the case, are you supplementing your operating cash? And really it shows on here investments, but it might be from selling other assets. It might be from taking out additional debt financing. So this really gives you that idea, again, where cash is coming and going. And in my mind, an incredibly crucial and important statement to look at when you run into a situation like we've had the last 14 months and you're dealing with operations outside of the norm and where some of those cash items are coming and going. Just a couple of footnote examples too that I'll touch on briefly. I won't get into a lot of detail, but just some footnotes that I think are very beneficial for organizations to look at when you're looking at external financial statements, if they have footnotes in a review, an audit, or compilation. The liquidity footnote, I talked a little bit about this on that statement of financial position, but what I love about this liquidity footnote is it gives you that ability to look at what are considered to be the liquid assets for the organization over the last 12 months. And what a lot of organizations will do is they'll look at this in comparison to what their operating expenses are. So you might have an organization that has $3 million of liquid financial assets over the next 12 months and $6 million of operating expenses. So that $3 million of liquid assets to $6 million operating expenses says you have about 6 months worth of cash on hand to cover your operating expenses. And again, this number, I think I've seen a lot of organizations look at and take into consideration over these last 14 months as we've run into that circumstance where cash is very important. Having an understanding of how long does that cash last us? What's our cash burn? This gives you that ability to look at it and kind of have an understanding of where that number is at the end of your fiscal year on the financials. If we talk about investments and the fair value of those investments as well, if you have an organization that is diverse in terms of what you have your investments put into, this is certainly good to look at to give the reader of the financial statements an understanding of where are we putting this excess cash? Where are we invested it? Is it in assets that are easily identifiable and able to get values on, like common stock or something along those lines? Or do we have it invested in maybe riskier or harder to value assets that would be disclosed differently in these footnotes to the financial statement? So having that understanding of what those investments are, again, you might just see it as one line item on the statement of financial position, but this gives you that idea of what are we really invested in? What's the organization invested in? Where are they putting their money into? So you have an understanding from a risk perspective. An area we haven't really talked about today, but certainly is a big area for nonprofits, an important one to understand is endowments. And endowments and looking at net assets. When you're evaluating those, it's always nice to see where are the restrictions for on the net assets of an organization. How much do we have restricted for endowments where the corpus balance is held in perpetuity and can't be spent, or maybe we've got net assets restricted for certain purposes? What are those purposes? Having an understanding of what those net assets are that are restricted at the end of the year so that readers can have an understanding of what the operations are and where those funds are that are having to be held for certain purposes going forward in future years for the organization. And then if we talk about debt, leases, commitments, again, another area I like to look at, because right now, while operating leases aren't specifically shown on the balance sheet statement of financial position, that is coming up here soon with the new accounting standard. So having an understanding and really knowing what the future commitments are, and that all ties back into that cash flow, knowing what type of commitments you might have for the next year, the next 3 years, the next 5 years as an organization. What are you committed to paying? what are the obligations from a financial perspective of an organization going forward. One other area too that you'll often see talked about when we refer to external financials is the annual reports. I always love looking at annual reports because, in my opinion, it's a great chance for an organization to blend both financial results, summary financial statements, and then putting a narrative in there too. So telling the story of an organization. And I think the ability to do that is certainly very much a key part of these annual reports, especially when you consider who a lot of these go to. Maybe it's the individuals that you serve or the donors that help to support your organization. And what I've also seen is an increase in the ability for organizations to put maybe some other information in, whether it's charts or graphs. What are some of the key performance indicators that organizations are wanting to communicate, whether it's certain financial ratios on amount of dollars spent per participant that you're helping to serve, or maybe it's the dollar amounts going towards this specific program, and doing comparisons on different areas outside of the traditional financial statement perspective and viewing. And so that's certainly an area that we've seen a large increase in organizations kind of trending towards and looking at. And then kind of the last area here that's going to segue into Joseph's conversation is not just the financial data that we've talked on, but some of the non-financial data, right? What else is out there that we're not talking about in terms of these financial statements? What's some of that non-financial data that we'll want to look at?
So while we get started, just touching back on the objective of this portion, excuse me, is I would like you to consider the data that your organization produces and what you're doing with that data. If I want to use an analogy, so our external financials, you have two portions. The basic financial statements is basically a tabular format of numbers. And then you have the footnotes, which is a bunch of words. And what's the relationship between the two? You have numbers for accountants like me, and then you have words to provide context for everybody else. And I would argue that those are both equally important. Maybe the context might even reach more people than just a table of numbers. And so part of our course description as well is the funding, as you might have seen. And in this area, I would like to focus on how do we obtain that funding and how do we provide context to what that funding provides or allows our programs to do. Many of you, it may be to attract volunteers or provide a platform for those volunteers to then serve their communities, which I think is great. And so in the same tone as the context, I would like to say that to obtain that funding, either from a grant tour or maybe fundraising event, what do we need to do? We need to communicate to the people that are making that decision. Should I approve this grant request, or should I open my checkbook and write a check to this organization? And I think one way to increase that, once again, not the only way, but maybe one way, is to communicate the context of the value of your organization or the programs that you're providing. All right, so now the fun part. I also enjoy humor. So this slide does have a little joke on it. And let's see if you get it. If you've read financial statements, I'm sure you get it immediately. But this is from the FASB, Financial Accounting Standards Board. And essentially, as an accountant, when I have a question, is your financial statements prepared in conformance with GAAP? Is there a new scenario this year compared to last year? Where do I look? Well, the first stop I might choose is the FASB. They have a lot of great stuff in there. They try to encompass everything. It's constantly being updated. So anyway, as far as non-financial data, I referred to my trusty FASB, and this is what I found, the FASB Master Glossary. I wasn't able to find a definition for non-financial data, but I did identify non-financial asset, and I'm here to argue that those two, if they're not the same thing, they're closely related. So anyway, let's see what the FASB has to say about non-financial assets. A non-financial asset is an asset that is not a financial asset. And there you go. Thank you, FASB. That was very, very enlightening. So let's move on. So back to our polling question about what is non-financial data. Well, FASB says a non-financial asset includes land, buildings, use of facilities or utilities, materials and supplies, intangible assets, or services. So I thought that was interesting. If we think about the context of a balance sheet, we all know where our PP&E goes. We all know where our intangible assets goes, but where do the services go? I guess that could be the activities on your income statement, or that's the result of your services. But anyway, I thought that was interesting. Keep that in mind. Your services are considered a non-financial asset. And so then if FASB is informing us that an asset that is not a financial asset, what is a financial asset? So it's pretty simple. It's cash, evidence of ownership in an entity, or a contract, which I also find interesting because a contract isn't really a tangible item. So I guess that could be an intangible asset. Anyway, further arguments and discussion for FASB in the future. So moving on, non-financial data, where is its value? Is it a wasted resource? Well, here's some guidance on how we can measure our non-financial data. One, we can assume or premise that it's appropriate for its highest and best use. And so in this context, I would like you to consider, is your non-financial data idle, or is it being used for its appropriate highest and best use? Are those volunteers being utilized efficiently and effectively? Which obviously that's the million-dollar question. Are your participants or those receiving the benefits of your program and services getting the highest and best use of your program and services? I don't know. Maybe you do, maybe you don't. We can work together to find out. Another measurement metric is the principal or most advantageous market. So are we serving, or are we operating within, or have we identified the group of participants that could be the highest and best use of our resources and programs and services? And then another measurement of non-financial data is that it's data that represents the participants. I found this interesting because I think a lot of us, myself definitely, when I think of an organization, nonprofit, government, or otherwise, I tend to associate or give that organization a unique identity. But if I want to think about the underlying facts, that organization actually represents the participants that it serves. And I think that's true of most organizations. Without those participants, you don't have an organization. All right. And so here, circling back on what we just talked about, if you see this graphic here, what do you think? Does this impact or make a better impression on the information being communicated? Does it provide context? Would you prefer to see this as a number in a table or possibly a sentence? This is what I would like you to consider going forward. And why should we care? If we go back, fundraising and budgeting. If you're asking a grantor or potentially someone to fund your operations and you want to make an impression on them, what might be the best way to do that? Once again, there's no one right answer, or maybe there is one best answer and no one's figured it out yet, but I'm sure there's multiple good answers. So in this case, if you look at this graphic and we wanted to communicate or convey information about changes in federal TANF funding, and TANF, if you're not in government or nonprofit, is temporarily assistance for needy families. And so if I look here and I wanted to tell you, who do you think needs more federal funding in the United States? Well, I don't know about you, but my eye is immediately drawn to Nevada because it kind of stands out. And it's actually the low end of the spectrum there on states receiving federal TANF funding. That allows us to maybe go in two directions here. So maybe they need more federal funding, or maybe they're got something figured out in their operating structures that they don't need federal funding. From this alone, we can't make that conclusion, but this kind of points us into one of those two paths, and we can do some more work or research to gain more insight. And so ask yourself, is your data being used in its highest and best use? Does your data help you identify your principal markets, or does it provide relationship insights? With that, I didn't want to leave without possibly mentioning a letter from the AICPA. They're the ones who have all the good ideas. To the OMB, the Office of Management and Budgeting. They're the ones that make all the decisions on whether those ideas are valid. And in September of 2020, the AICPA communicated to the OMB. They're aware that the OMB is working on agencies to include performance information. So when I think of performance information, that could be financial, non-financial. The Department of Justice states outright that performance metrics are currently under development. So what's a performance metrics? It could be, did you hit your revenue goal? It could be, did you serve 100 participants? It could be you had 1,000 volunteers, and that's why we need to continue receiving funding, or possibly we're growing and we could use more funding, and providing that funding to us would be its highest best use because we serve our principal markets and because we represent our participants. And if you didn't catch the hint, that's the Federal Funding Accountability and Transparency Act, which might raise some alarms. It might mean nothing. But anyway, with that, we can open it up to questions or conversations. And once again, I appreciate your time. And that's all I got. One thing I wanted to say that maybe I left out of the conversation was on that last slide there, you've seen a statement, transform your data into information. What does that mean? To me, that means providing context. So if you do have a bunch of data just kind of floating out there being generated by your activities, your programs, your services, and it doesn't mean much to anybody because maybe it's like looking at a CSV document or a text document with a bunch of words and no punctuation, no structure. That's your data. What you want to do is take that data and transform it into information, providing context to then convey to your grantors, fundraisers, the value that you provide.
You know, as I stated earlier, this is the third part in the webinar series, and I think as a firm, we've been incredibly excited with the number of participants that we've been able to generate with this. And so excited just to be able to share the knowledge of some of these different aspects of financial reporting that we have. And again, certainly welcome any other questions that you might have along the way. You know, if with financials and nonprofits, the rate of change is probably only going to continue to increase. So as such, gathering knowledge and getting input is certainly going to continue to be more and more important.
Perfect. Well, no questions coming in right now, but here is the presenter contact information should you have any questions. And we just thank you all so much for attending. Thank you, Reed. Thank you, Joseph. And we hope everyone has a great day.